The day the dollar dies, how real estate survives when money doesn't. 1. The Ghost of Weimar. Picture Germany, 1923. The currency collapses overnight. People carry cash in wheelbarrows, children make kites out of banknotes. Amid this chaos, one man rises, industrialist Hugo Stinnes, the inflation king. He borrows mountains of paper money and buys hard assets, factories, coal mines, land. When the mark dies, his debts vanish, and his empire remains. So what does that actually mean? It means that when paper burns, assets survive. Hyperinflation doesn't destroy wealth, it redistributes it. Footnote. This section illustrates inflation-induced debt destruction and how tangible assets can preserve value in a collapsing currency. 2. When money melts. The same pattern replayed in Zimbabwe, 2008, and Argentina. As currencies dissolved, people rushed to trade paper for reality, land, livestock, houses, anything that couldn't vanish with a printing press. When money loses meaning, walls and soil become the new gold. So what does that actually mean? It means survival favors the tangible. The wise exchange digits for dirt before digits die. Footnote. Hyperinflation forces capital flight from currency into physical goods, making real estate a temporary store of value amid collapse. 3. If the dollar falls. The U.S. today faces the same mathematical trap that destroyed past empires, $37 trillion in debt, and interest payments surpassing defense spending. At this scale, there are only two exits: default or devaluation. History shows they always choose inflation. So what does that actually mean? It means the printing press becomes the escape hatch, and your savings account becomes the casualty. Footnote. This section outlines how sovereign debt levels create pressure for inflationary devaluation rather than outright default. 4. The housing shockwave. In a dollar collapse, chaos hits housing first. Inflation explodes, interest rates skyrocket. Banks stop lending, credit freezes. Construction halts as costs spiral daily. Paradoxically, nominal home prices soar, not because homes gain value, but because dollars lose it. A suburban home could be worth billions of worthless currency. So what does that actually mean? It means the housing market doesn't crash in numbers, it crashes in meaning. Footnote. Inflation distorts price signals, creating nominal booms that hide real collapses in purchasing power. 5. Winners and losers. Winners, homeowners with fixed-rate mortgages. Their debt melts away. Each payment buys less, yet erases more. In Weimar, entire mortgages vanished in months. Losers, those with adjustable loans, renters, and banks. Variable rates spike, rents become unbearable, and lenders are repaid in dust. So what does that actually mean? It means hyperinflation inverts morality, debtors are rewarded, savers destroyed. Footnote. Inflation-induced debt destruction reverses traditional financial incentives, punishing prudence and rewarding leverage. 6. The government's desperate hand. Expect emergency decrees, price caps, rent freezes, credit holidays. But intervention breeds new crises: black markets, housing shortages, urban decay. When a currency breaks, laws can't mend it. Only replacement can. In 1923, Germany introduced the Rentenmark, backed by land and industry, restoring stability. The U.S. might do the same, reissue a new dollar, pegged to hard assets or digital reserves. So what does that actually mean? It means collapse always ends with reinvention, but not without blood in the balance sheets. Footnote. Hyperinflation ends only when faith is restored through a new, credible, asset-backed currency system. 7. The fire sale of a nation. If the dollar collapses, foreign currencies rise. To outsiders, American homes would look cheap. Stable foreign money could buy U.S. real estate at fire sale prices. The land remains, but ownership crosses oceans. So what does that actually mean? It means the fall of a currency often marks the sale of sovereignty. Footnote. A devalued domestic currency invites foreign capital to acquire real assets at deep discount, accelerating capital flight. 8. The slow burn. Most economists predict not a collapse, but a slow erosion, a managed decay. Inflation outpaces interest, debts shrink in real terms. Quiet theft replaces sudden disaster. It's hyperinflation, just stretched over decades. So what does that actually mean? It means the storm has already begun, you're just living in its drizzle. Footnote. Financial repression gradually transfers wealth from savers to debtors through sustained inflation below real interest rates. 9. The final refuge. A house doesn't vanish when a currency does. It shelters, endures, anchors value in a storm of numbers. In collapse, the home becomes the lifeboat, not unsinkable, but afloat. So what does that actually mean? It means real wealth isn't counted, it's built, lived in, and remembered. Footnote. Real estate's intrinsic utility makes it resilient through monetary collapse, even as surrounding institutions fail.